Welcome to a video that I like to call the deep dive video, and I feel I need to explain that because I don't want this to be misleading. Every week I do a number of videos. I do a video each day. I also have a number of charts that I don't really show in any of the videos, but I would still like to present. And so what I do at the end of each week after I finished all the videos, I go back and I look at all the different charts. I take the charts that are just informational, but sometimes kind of interesting. And I put them together into this video because sometimes we can get some insight or some clues as to what's happening by looking at these charts and then coupling them with the charts that I go over in the other videos to kind of get more of a consensus as to what's happening in the market. This is being prepared from Monday, February 5th. The first chart is for information, and I only show it in this video. What you don't see on here is the VIX. The VIX is a fear gauge. When the VIX is high, it's time to buy. That's because we've been going down with stock prices. When the VIX is low, it's time to go. That's because we've been really going up and there's not a lot of fear in the market. I take the VIX off of this chart by making it invisible. And then over top of that, I have a 50-period exponential moving average. When the VIX was first designed, it was meant to be used with static numbers. When we get 12 or below, that means there's no fear in the market. When we're at 20 or above, that means there's a lot of fear in the market. Well, by using the moving average, we can see that there's a range that is established that doesn't always stay within those static numbers. Back in about 2007 into 2008, when we went through the great financial crisis, the VIX was giving very high readings. Then as things settled down and we started to go up, we set into more of a lower range for the VIX. Then after the COVID plunge, we went into a higher range. And now over on the right-hand side, it looks like we're setting a lower range for the VIX now. This is not anything that we use really to make decisions on. We use other charts for that. This is really just to give us some information about the current market climate. Another chart that I do use from time to time is we want to see how fast is the VIX moving. And I measure that by using an RSI based on 9 periods. When we're really going up and getting a high reading and the VIX is looking extreme, that means it's gone up really far, really fast because stocks have really been falling. When we get a really low reading, that means that we're really going up pretty fast. And sometimes that can be used with other charts to signal that maybe we've hit some kind of a top or at least a slowdown. Right now, we're just about at the midpoint. We're not getting any kind of an extreme reading, so I haven't been including this in the videos. Then on top, we look at a thing called the MOVE Index, which is relatively new, and so it's really hard to do any historical analysis with this. I've kind of had to learn it more in real time. This measures the volatility of bonds. And then in the middle area, we have the VIX, which measures the volatility of stocks. Down on the bottom, the green line is just the spread between the VIX and the MOVE Index. The red line is the S&P. What I pay most attention to is at the very bottom, the correlation between the two. And right now, they're kind of neutral with each other. Bonds and stocks have kind of been decoupling lately. So this chart hasn't been all that helpful. We also look at the VIX, and then we take a 3-month average of the VIX and turn that into a ratio. And as a general rule, when this is going up, that tends to be more negative for stocks because stocks are going down. When this is going down, that tends to be more positive for stocks. And as we hit some bumps in early 2024, we're getting a lot of the higher readings in this calculation, and so we've been turning back up. This is a little bit of a warning sign, but our shorter term VIX charts are suggesting that things are positive, at least for right now. We want to keep an eye on this. We want to eventually see this turn and go back down if we're more positive. If it keeps going up, we would remain more negative. Also, we look at the VIX itself, and then there's another indicator of the VIX called the VIX of the VIX, and that just measures how fast is the VIX itself moving. And then we take a ratio between them. When it's going down, that tends to be positive. When it's going up, that's negative. We've been flat to slightly increasing lately with this ratio. Again, this is something that we keep an eye on. And if it really starts to turn and go up, that would be negative. If it starts to turn and go down, that would be more positive. Then we look at a 253 period moving average of the equity put call ratio. And when stocks are going down, this has a tendency to go up. That means that people are buying a lot of puts to hedge their positions. When this is going down, they're either not buying as many puts or they're buying more calls, and they're not as concerned about prices falling. Well, we have been coming down, but as we hit some problems in the early part of 2024, this has been ticking up, but it's just barely starting to go down now. We want to just see this continue to go down if we're more positive. If it keeps going up, that would be more negative. Then we take a ratio between the VIX and the MOVE index. And when this is going up, that means that stocks are more volatile than bonds. When it comes down, that means that bonds are more volatile than stocks. And we came down to the moving average, and we're starting to turn up a little bit as stocks have become a bit more volatile than bonds lately. Then this is a fear gauge that sometimes I show this in every daily video when it's really moving and telling us something. We've been chopping more or less sideways. When this is going down, that means there's decreasing fear. When this is going up, that means there's increasing fear. So we read it the same way that we would with the VIX. And since we've been just chopping around, not really doing all that much, I haven't been showing this. Another fear gauge that we look at is we can see in the longer term that we're seeing decreasing fear as the market had been improving. And when this is going up, that means there's more fear. When this is going down, that means there's not very much fear. And so far in 2024, it hasn't been moving all that much. We've been getting what I feel is enough information from the other charts that we look at and I show in the daily videos. Then this has been kind of a disappointment lately. We look at this as a risk on. When this is going up, that means folks are favoring stocks. When it's risk off, that means they're selling stocks and possibly buying either less growth-oriented stocks or maybe even buying bonds. And we've been chopping all around right now. So I haven't been including this because it's really not giving us any insight these days. And this is just information. Since we hit the recent or the previous all-time high with the S&P 500 that was set in early January 2022, we're now 2.91% above that previous high. When I use this chart is when we're going down, I say, okay, how much have we retraced from the all-time high? Just to give us an idea. Well, now that we've surpassed that and set a new all-time high, this is now a plus number instead of a minus number. Then we've been keeping an eye on this too. And I used a lot of these charts in the daily videos, especially for Monday's session, where we're watching the advanced decline line. That can give us some clues as to what's happening internally in the market. On top, we have the common stock on the NYSE, and that's been chopping around a little bit, not really breaking out. We're also seeing a lot of choppiness when we measure this based on volume. The reason why this isn't really moving all that much right now is because we're seeing a lot of the real movement in the mega caps. Specifically in Friday's session, Facebook was up over 20% or something. And so we actually ended up having kind of a down day when you look at the broad market, but because of the big mega caps doing better, that's why the S&P ended up setting a new all-time high. Then stockcharts.com has this thing. Sorry, I have to keep clearing my throat here. They have this thing called technical alerts, and these are automatically triggered. They're pre-programmed. They look at not only the S&P, but they look at different sectors inside of the S&P. They look at other indexes. They look at other markets. And you read this from the bottom up, where this was Monday's session. And when it's something negative, it's red. When it's something positive, it's blue or green, depending on how you see the color. And you can see as we go throughout the week, when we see an awful lot of red, we're probably having a down day. When we're seeing an awful lot of blue or green, we're probably having an up day. And so this just tends to confirm other positive things that we see going on. This is something that you can watch during the day just to get an idea. You may not be involved in any of these other markets, but you can look at this and just go, okay, we're seeing confirmation, either positive or negative, as the market is going up or down. Then we look at 5 main indexes. I look at a lot of different indexes, but for this particular part of the video, I look at the S&P, which is the backbone of everything that I do and I teach and the strategies that I implement. We also look at the Dow because it's very influential. We look at the NASDAQ 100. We look at the mid caps and the small caps. And then Stock Charts has this non-emotional way of rating the chart of that particular index. You can do this on stocks as well. I use it for indexes. And the higher the number, the better the score. And it's on a scale of 0 being the lowest and 100 being the highest. And then I rank them. what's looking best all the way to what's looking worst. And as has been the case lately, we have the QQQs, which is the ETF for the NASDAQ 100. They are coming in first place at 94.2. And then we get a bit of an idea of how this has changed over the last few months. And they're looking pretty strong. Whenever I'm looking to get into something, I want it to be in the high 80s or low 90s at a minimum. I'm not a buy on the dips kind of person, because a dip can turn into a really bad decline very easily, that I've learned over decades of being involved in this. I like to buy into strength and sell into weakness, but that's just my own personal philosophy. Then coming in second place is the S&P 500, because there are a lot of components in the NASDAQ 100 that are also in the S&P 500. It's coming in with a score of 88.6. In third place is the Dow, coming in at 85.7. So we've got the bigger companies and the blue chip companies, the best quality companies, they're performing the best. Then we start to drop down the scale a little bit. We go into the mid caps, and even though it did bounce back up, we're still getting a reading just barely above 50 at 57.7. And then in last place, which we should be at 100 by now, according to the January effect, but we had a really good December with the small caps as measured by the IWM. This is the ETF for the Russell 2000 small caps. And it came up and it got up into the 90s. And then we hit the new year, and we've just been going down ever since, with little pockets of strength in between. But right now it's coming in at 31.2. And some short-term charts. The first thing that I look at here is I look at this whole chart, and these are short-term moving averages that I have in different colors. So I call this a rainbow chart. This goes from 10 periods up to 50 periods. And when all the lines are going up, that means the short-term trend is positive. And when price is above all the lines, which they are right now, that also confirms that we're in an uptrend. Now, it doesn't take a genius to figure that out, but when we're really chopping around, looking at a chart like this can sometimes be helpful. Then we also look at a 20-period moving average, which is calculated in a different way. This is a double and a triple exponential moving average, so it moves a lot faster. And price is above both this green line and this blue line. Sometimes I'll pull this out and show it because it may provide support. When we're coming back up, it may provide resistance. We've been just trailing along this for the most part now, and we're seeing the upward trend with other charts that we look at, so I haven't included this one. Here's a regular 20-period moving average study, and the debate goes back and forth. Do you use a simple moving average? Do you use an exponential moving average? Well, a simple moving average treats all 20 periods the same. So day number 1 and day number 20 get the same amount of weight in the calculation. Where an exponential moving average, it puts more of the weight closer to current prices. And you would think logically, well, yeah, naturally, I should use the exponential moving average. But a lot of research that I've consulted over the years suggests that if you stick with simple moving averages, you tend to do better because you're not making as many decisions. And so, but there are people that still prefer them, and they're always asking me which one is best. So I plot them both on here. We can actually get a little bit of insight from this. We see that the blue line is above the red line. That means the exponential moving average, which moves faster than the red simple moving average, that means we're going up pretty strong right now. So we're seeing a good solid uptrend. We're also seeing where price is above both of the lines. So that's also positive as well. Then intermediate term, we have another rainbow going from 50 periods up to 100 periods. We're a little bit more above the lines because these are longer term moving averages here. And this is still looking positive in the intermediate term. And then we have the same idea with the double and triple exponential moving averages, but they're based on 50 periods. And we've been in a channel here for quite some time, and sometimes this has been acting as support. We've been riding this up, which you could say is acting as resistance, and we're above this red line now, which tends to move faster. And in the intermediate term, when the red line is above the blue line, that means that we're going up with a little bit more conviction. Then a few months ago, I was looking at this chart very heavily. Most moving averages, you look at the close from right now, and then you go back 20 periods or 50 periods or 100 periods. That's looking back. Well, an anchored moving average, you can set some kind of a high or low at some previous point, and then it projects it out up to current prices. So instead of working back with regular moving averages, this tries to look forward with what we call anchored moving averages. And when we were having some trouble last October, we actually dropped down below this for a while, but then we were able to recapture that. We've been going up and we're far away from this red line. So I haven't been showing this chart since we're so far away. Then we use a thing called a Connors RSI. I have a lot of oscillators that I use, and I use this like an oscillator as well. We look for extreme positive or negative readings when we've been going up or down too far, too fast. When we're above the midpoint and going up, we tend to be more positive, and that's what we're seeing now. This is pretty spastic. It moves around a lot, but we don't get a lot of extreme readings all that often. So I just look at this every day, and I only really pull it out when we're getting some kind of an extreme reading. Here's a 50-period moving average study. The same idea as what I explained with the 20-period moving average study. This is a slower moving average, so we're further away based on price. And we're starting to see the red line go back kind of more even here with the blue line. But as we were really going up, we see the blue line, which is the exponential moving average, that has been above it. That means that we have some real strength behind this move because the blue line moves faster. As we were going sideways and then had a little bit of downtime here, we saw these lines coming closer together. So we're okay, and I haven't been showing this chart, but we want to watch these lines to see, are they going to end up falling? Is the blue line going to go underneath the red line just to see if things are slowing down? Then we do the same thing here with the 100-period moving average study. And this is still more intact where we have the red line, the exponential moving average is above the green line, and price is well above both. And this just measures how far are we above or below the 200-day simple moving average. We're looking really good here. The one thing that I would warn you is you could see where, well, we made a high here and we're making a lower high here. Oh, that's a negative divergence. The end of the world is coming. No. That's because the 200-day moving average is also going up. And so we're closer to it when we set a new all-time high than we were when price was back here. So that's not necessarily meaning that there's a negative divergence going on, but this is really more just informational to let us know where things look on a graphical basis. Then we want to measure how fast is something going up or down. Standard deviation based on 10 periods. We use that not to measure direction, but we use that to measure speed. Are we going up or down quickly? Well, as we were really going up here for a while, we saw standard deviation break above the moving average. And now that we've been kind of chopping around and we had a down day and then an up day that kind of ended where it started, we're turning back up a little bit, but we're showing that the standard deviation has been decreasing. And then the mass index, this is not generating a signal. We only pay attention to this when we get to the red dash line, and then after that to the blue line, and we're far away from that right now. We want to keep an eye on the S&P 500 and then compare it to the S&P 100, which are the biggest 100 stocks in the S&P 500, to look for any kind of convergences or divergences. Right now, they're pretty much converging with each other. The S&P 100 has been outperforming, and you would pretty much expect that in a more solid environment as the mega caps have been outperforming. About almost a year ago now, we were seeing a negative divergence where the S&P was breaking out, but the S&P 500 was actually going sideways. That's the kind of thing that we look for in this chart, and I'm just not seeing anything like that currently. And this is just some measurements. When we hit the low in October of 2022 and then bounced back up off of there, then we started to fall back. And then this is when we bounced back up after the October 2023 low. And then this is how far we've been going up. And I put these lines on here myself, so these are not exact measurements. We keep an eye on the thing called the percent B indicator. Bollinger Bands have a lot of different uses. And when we're above the midpoint of the Bollinger Band, that's positive. When we're below, that's negative. Well, the percent B measures, are we outside of either the upper or lower Bollinger Band? Because we don't spend very much time that way. And so if we get a really extreme reading with this indicator, it tends to not last very long and often will mark either a slowdown at a minimum or a decline sometimes. And right now we're positive and we're not extreme. We're positive because we're above the midpoint. Then we look at a thing called the CMB Composite Index, which I was showing earlier in the week because we were getting an extreme positive reading. When we had that big down day on Wednesday, this really dropped and it hasn't resumed its upward move at least yet. Then we look at a point and figure chart, which doesn't take time into account. It just takes price movement. And as I usually explain, it can take an hour or it can take a year for enough of a price movement to occur before an X or an O is drawn. We are looking pretty positive here. The last signal that was triggered was a top breakout on a double top breakout on November 20th. And we've been working off of that ever since. And we've been seeing some new X's along the way that are drawn in here. And so this is also confirming that things are still looking pretty solid. The Pring bottom fisher is pretty good for when we're really going down and we set some kind of a bottom in the market, and we use that to confirm with other indicators that we're seeing. Right now, it's getting ready to cross, but it's not really a signal because we're hitting a top right now rather than a bottom. Some long-term charts. Here's another rainbow going from 50 periods up to 250 periods. We're above all of the lines in the rainbow, and the longer that we stay above that, the more these lines will thin out. And this also suggests that the long-term trend continues to be positive. Then we have a thing called the daily special K chart. And this is a long-term oscillator, and we don't get many signals from this at all. But when we do get a signal, it tends to be a big deal. We had a cross below here right at the beginning of 2021, and then we had all kinds of trouble after that. And we spent all of 2022, we had a cross below in 2022. And then we didn't see much of a cross. We tried to cross here in early 2023. That failed. But then later, we also had another cross. Then when we were having some trouble, we started to drop below. But currently, we're now above this line, the moving average. And I don't show this because we can go months at a time without actually seeing a signal that's drawn. And so I like to show it in this video, so at least gives you a chance to see it once a week. Then most of the charts that we look at are based on a log scale. And you can click a little button and it switches over to an arithmetic scale. And sometimes this can be useful. We have a weekly chart of the S&P and then going back to the 2009 low. And then I just drew a trend line matching up these lows. Well, you can notice sometimes this acted as overhead resistance a number of times along the way. And when we were dealing with this, it's like, okay, I was pulling this chart out, looking at it, but now we've broken above that and we're well above the line. So I haven't been showing this chart. Then we take a weekly look at the S&P 500 on top, a weekly look at the German DAX in the middle area, and we can see right now that they have a pretty strong correlated relationship. So if the European stocks are doing well, that might help the US stocks do better. But at the same time, if the European stocks are down, that might also put some pressure on the US stocks. And sometimes this correlation is pretty strong like it is now, but we went through a number of weeks where they were not really matching up much with each other. Then we look at the 10-year yield in the US and we subtract the German 10-year yield. And because US rates are higher, we get a positive answer. That's the red line. That's a 0. And sometimes, not now, but sometimes we can put the US dollar index down in the middle area, and there might be a correlation between the two. Even though we're improving, we're still right about in the neutral area right now. So this chart really isn't giving us any insight. Then we look at different support and resistance, and I don't have any fib levels now because we've broken out above all the fib levels that we've been using for the time being. But this is one. This is a 20-period simple moving average of the open, high, low, and close that I can use for support and resistance. And sometimes when we're going up and we fall back, one of these lines may act as support. Other times when we're going down and we bounce, one of these lines may act as resistance. We're well above all of the lines now in this little mini rainbow is what I call it. And so this chart really isn't providing us with any insight. When we fell after Chairperson Powell gave his testimony on Wednesday, I thought, okay, if we fall a little bit more, I'm going to break out this chart, but we never made it down to that level. And then, at least for the last year or so, the 50-day cycle has been somewhat helpful. You can see I started marking this from the COVID low, and then you can see other times when it was pretty close to a high, pretty close to a low, pretty close to a continuation. Not really sure if this is helpful or not. I use this mostly for informational purposes. When you start basing things on cycles, you're trying to apply a real number that in a fluid environment, and it's helpful. Sometimes it can be insightful. It's good to know when these things are happening, but I don't base decisions around these kinds of charts. Then we have the Ichimoku cloud, which really are just a set of moving averages placed on the current price of the S&P and then shifted forward. When it's green, it's up. When it's red, they're down. And we're above all of the clouds here. Sometimes when we are going up and we fall back, some area within the cloud may act as support. When we go down and we start to bounce back up, some areas within the cloud may act as resistance. And we're far away from the cloud right now. Then some broad market indicators. This is a resistance area for the financial sector, and we're well above that right now. So I see no need to include this chart. I also follow the Vixen, which is the VIX for the NASDAQ 100. And I mainly follow the line chart in here because we got like all these icicle things falling off here. I don't use the Vixen that much. I look at it every day, but I use the VIX because I'm focused more on the S&P 500, but it's still helpful to know what's going on with volatility of the NASDAQ 100. Then we have, I thought I already showed this, common stock, and based on price and volume. I did show that one earlier. Then we have a ratio where on the top we have the S&P 500, and then the ratio is the Qs to the diamonds in the middle area, and they're neutral right now. They had a pretty strong relationship, but now that's starting to go by the wayside a bit. The banks, we want to keep an eye on the banks. We had some negative banking news this past week. We're wondering, is that the only news we're going to get, or is there going to be more coming? We had the big decline last March, and then we went sideways. We've been showing a lot of improvement. We did see some weakness in the banks, and there's a lot of fear out there, wondering, is this going to lead to something like what we saw back in 2008? And then we took a real hit here with the regional banking ETF. The New York Community Bank, that's a regional bank, and that just got hammered. It went down like 11% in one day. And then we compare the regional banking ETF with the financial sector, and this is showing how it's really been underperforming, which is too bad because we've been seeing the regional banking ETF start to outperform the financial sector as things were looking better, but now that's a little bit into question, so we want to keep an eye on this area. Rate of change charts, these are just for informational purposes. We're starting to tick back up a little bit. It's hard to see that. This is a longer term chart. It actually looks like it's going down, but really it did tick up in the latest reading. Keeping an eye on bonds. We look at 1 to 3 year bonds and we compare them with 3 to 7 year bonds. When this is going back up, that means there's fear of interest rates going up. When this is going down, that means the market is less fearful about rates going up, and they may even anticipate rates coming down. We were really going down here, and then now we're just kind of chopping around as the market is trying to figure out what's the Fed gonna do. And then here's an inverse of that same thing where we look at 7 to 10 year bonds and compare them with 3 to 7 year bonds. When this is going up, that means that there's more confidence that maybe the Fed is finished. Then we started to fall back. Now we're starting to go back up. And then we look at the long-term bond ETF, that's in blue, and the S&P 500, which is in red. And we look at the correlation, the relationship between them, and it's starting to trail off just a little bit in the longer term. Usually the 50-period correlation tends to stay pretty close up here to the top, at least it has for the last few months. And you can just look at the chart where you see the red line going up and the blue line going down. So yeah, they're going in opposite directions. And we're seeing that played out a little bit more with our shorter term correlation, meaning their short-term relationship isn't as strong. In fact, it's a little bit stronger than it was. They were showing more divergence from each other. Then we have the QQQs and then the long-term bond ETF. For a while there, through the month of December, their relationship was really strong, and now we're starting to see that trail off a little bit here. Then we keep an eye on the different yield curves. The important ones are the 10 to the 2 and the 10 to the 3 month. We're still inverted. We show some improvement, and then we start to fall back down with both of these. I think it's the 10 to the 2. We've been, my gosh, we're going on over almost 2 years that that's been inverted, and about a year and a half that the 10 to the 3 month's been inverted. And then we look at 3 to 7 year bonds and we compare them with stocks. When this is going down, that means that bonds are underperforming, which, to say it another way, it means stocks are outperforming. And then we look at TIPS, which are Treasury inflation protected securities. When this is going up, that means folks are worried about a rising interest rate environment because they get into TIPS because they're shorter term and they can adjust for new interest rates. When this starts to go down, people don't like the tips as much anymore. They get into further out bonds. They want to lock in a higher yield that they think is going to last for a period of time. And we're still seeing this going down overall trend-wise, but we've been chopping sideways for the last few months. Then we look at that same idea, taking the tips, and we look at further out bonds, where we were really coming down here back in October, and then we started to go back up, and we're starting to go back down now, and we're seeing a crossover here. And this just means that as this is going down, that there's less and less fear about inflation, which means interest rates going up. Then we look at the 1 to 3 month T-bill, which you could pretty much call cash. We compare it with the 3 to 7 year bond. When this is really going up here, that means there's a lot of uncertainty about interest rates. We're pretty much in a rising interest rate environment. Well, then we started to come back down, then we went back up, then we started to come down. Then over the summer, when the market was under a lot of pressure, this just trudged its way higher. Then we finally hit that low in October. This has really been coming down, but lately we're chopping more or less sideways here, even though we're seeing a death cross here with the ratio in this chart. Then we compare the S&P with 3 to 7 year bonds, and we're setting a new high right now with this ratio. When we're up in this area, that means that the stock market anyway is anticipating a soft landing. Doesn't mean they're right. It's just what they're anticipating right now. And we've seen that for most of 2023 and now into 2024. Then we look at home construction, another very interest rate sensitive part of the market. If interest rates were going to keep going up, we would see this go down the way it was throughout the summer months. But once we finally bottomed with interest rates, now we're starting to go back up with this ratio. We're not setting all-time highs yet, but we're not far away from those highs either. Then I have a number of things called possible positive scenarios. These were developed, and I really use them a lot when we're going down and we're looking for some kind of a bottom. But I also use a lot of these charts every day. They can just give us an overall idea of the health of the market. Well, some of the charts that I haven't been using lately are what I have here. These are the percent of S&P 500 stocks that are above their 200-day simple moving average. So this is longer term. When this is above the midpoint and going up, that's positive. When it's below the midpoint and going down, that's negative. We can use this like an oscillator when we get an extreme positive or negative reading, but we haven't had one now for quite some time. We use that same basic idea, but we use a 50-period moving average here, where we did get extreme right at the end of December, and then we've been falling back. We're still above the 50 level here. That would be the midpoint. So we're okay. If we fall below 50, that would turn things more negative. Then we look at the mid caps, which also went extreme right at the end of 2023, fell back. They're not showing as much of an improvement, but they're still above the midpoint. And then the small caps, which also went extreme positive and have been falling back, and they're just about at the midpoint now. Then we look at a 19-day exponential moving average of the advanced decline ratio. When it's above the zero line based on price, that's positive. When it's above the zero line based on volume, that's also positive. We can use this to get extreme positive or negative readings. Right now, we're just more positive with this without being extreme. Thank you. I really hope you found this helpful. This is not meant to be a standalone video, so please feel free to check out the other videos that I post, specifically the daily videos. I know they're long videos, but the idea is to give you as big a picture look as I can in the shortest amount of time as possible. In spite of that, please have a very good weekend, and I will talk to you in the next video.